a lot of questions that say, hey, are you interested in buying this stock? Are you interested in buying that stock? And instead of answering those questions individually, I'll just answer the question of how would I go about answering that question? So how do I go about picking stocks? So in this video, we're going to go over the checklist of how I go about picking a stock. I'll just list down in the description what we're going to be going over today. So if you want to go down there and just read that instead of watching the entire video, feel free to do that. But anyways, let's get into this. Thing one for buying a stock. Do you fully understand that business? So in other words, do you know where they're going to be making their money? Do you know what type of profits they make? Do you know what type of competitors they have? Do you know if you were to just close your eyes for 3 to 5 years, 3 to 5 years from now, if you had to imagine where this business will be, what their plan is, do you know that? What do you know about this business? If you don't fully understand what they do exactly, you probably shouldn't be owning that stock. A lot of people will just see something trending up and they try to just buy into it and ride the wave, but they don't even know what they're buying. Number 2, have you read the latest 10Q or 10K for this stock? So basically what the 10K is the annual report. It goes over literally everything for this stock. Now, do you necessarily need to read the whole thing? I wouldn't say so. You don't necessarily need to read the entire 10K, but you should really be digging into some key parts of the 10K just so that you have a good understanding of the company. It's going to dive into the risk factors, competitors. It's going to tell you what their business model is. It's going to tell you what they did last year. And you might even want to go as deep as to read the last year's annual report. The 10Q is basically the same as the 10K, but it's just a quarterly update. It's a lot shorter. So definitely if you haven't read those about a stock, you don't know much about the business and you should not be investing in that company. Number 3, I recommend this for people, even if you're not picking stocks, just to understand a little bit more about the economy and a little bit more about the business. Actually, funny thing, if you go and listen to your conference call, let's say you work at a Fortune 500 company, go listen to the conference call. You'll figure out exactly what the plan is as far as profitability for your company, and it might make a little bit more sense on your level if you're not way up top already. What's going on? So yeah, definitely listening to conference calls gives you a sense of where the business is headed, what their plans are near term and long term, where they're investing their money, all these other things that you really need to know before you go into an investment. Number 4, do you know the risk factors for this business? Easy example, let's say you're investing in a retail business. Obviously we know what the big risk is for retail businesses. We got Big Brother Amazon coming through and just wrecking havoc on retail businesses. And do you understand those risks, or are you just buying some ticker symbol on a screen? Right? You should know what the outlook looks like for this company. Number 5, does this company have consistent profitability, or are they kind of a speculative company? In my opinion, not financial advice, obviously. There's my big legal disclaimer. If the company's not profitable, it should be a smaller portion of your portfolio. I like to keep it under 5%. Number 6, is the forward PE under the industry average? Basically what a forward PE is the price of the stock divided by the earnings that are projected by analysts or other sources. You can kind of get your own projected earnings, or another way to do it is the companies will actually forecast their earnings, so you can take their forward earnings. So for example, the price of a stock divided by the 2020 earnings would give me the forward PE for whatever stock we're talking about. So if the stock has a forward PE under the industry average, then you would consider that stock to be cheap or selling at a good price. Another little hack that's not like an end-all be-all that I use is looking at historical dividend yields. And not all stocks pay dividend yields, so you could look at historical price to earnings ratios. If historically a stock trades at about a 17 PE and is trading at a 14, you can guess that either something's going on with that business, or it might just happen to be on sale. There might not be anything wrong with that business, or there might be something that the public sees as wrong with that business that you don't necessarily see as a big deal. So you kind of have to look into that. All right, number 7, has the business grown net income and revenue for the past 3 years? So this could be 3 years, this could be 5 years, but in other words, you just want a growing company. And the reason why you want a growing company is because you want a growing investment. And the reasons why your investment actually grows is because the underlying company is growing. For me, this is a lot easier to see in the form of like a dividend stock, where the dividend will grow if there's just more money to be paid out. You want that money to be paid out to be growing, because then the investment is worth more, and then, obviously you're being paid out more, so that itself is worth more. Number 8, do you expect the company to grow net incomes in the future? So this is another good reason to hop on those conference calls and get in those 10Ks, 10Qs, because they will literally lay out their plan for growing the net income. They know that that's important to investors, and you should know that it's important to investors as well. Need to know that plan to grow the net income, because the net income is basically what you're buying when you're buying the stock. You're not just buying a little blip on a screen, you're buying rights to that net income. So if that net income has no plan to grow and it is not growing, you're not buying a good stock. Number 9, does that company have more in cash and investments than in debt? You wouldn't want in your own life for you to have more in debt than you have in cash and investments, because worst case scenario, let's say you lose your job or your source of income, whatever that is. Now you have more due in debts than you have in cash and investments. You want that balance sheet to be as strong as possible, because their income could go down for a year, and you just want them to be able to take that hit. If they're, exactly 1 for 1 on investments and debt, or even worse, the debt is higher than the investments, that is a huge risk factor, and you need to be aware of that. Number 10, does the CEO have a track record of growing the company? So when looking at the management team, you really need to look at not only historical returns, but just getting in those conference calls and just listening to them, looking at their track record as business people, and just seeing how well the company has done during their tenure, looking at even past companies that they've had. Let's say that they, were acquired from some other company. How well did the company do during their tenure at that company? Having confidence in your management team will help you when things dip, because things will dip, and that is a buying opportunity if you bought into a great company. Number 11, does the company return money to shareholders in the form of stock buybacks or dividends? So you definitely want to see those capital returns. So a lot of companies that are newer, you will not see this, but more mature companies, you definitely want to see some type of share buyback program or some type of dividend program. Not only does this show that they're very shareholder focused, but it also just shows that they're a mature company, they've got extra money coming in, and they're really not worried about much. Over time, these companies are going to be able to drive shareholder value, and they're going to increase not only the stock price, but the capital returns to the investor. Quick side note, some people don't understand how share buybacks create value for the investor. Basically what it is you have a bunch of shares on the market, and what the company does is it buys some of those off of the market, so the people that still retain their shares basically own a larger portion of the pie that is the company. So they'll buy some of the shares off the market, so now there are fewer shares, so the however many shares you had, now they're worth more of the company as a percentage. Hope that makes sense. Number 12, I call this one the knockout, or I don't know I don't have a name for it, I just made that up. Ask yourself this question: if someone knocked you over the head and you were out for 5 years, and you had bought shares of this stock at the beginning of the 5 years, if you had to be out cold for 5 years after buying these shares, would you feel comfortable holding those shares for 5 years? If not, this is kind of a deal breaker. Like, you should never own that stock in the first place. Study after study after study has shown that holding things for the long term, as far as investments, is much less risky, much less profitable, much more tax efficient, and it just drives more wealth creation over time. So make sure that you're willing to hold that stock for at least the next 5 years. Last one, and this is very important: would you buy more shares of the stock if it were to go down in the short term? So even in my very little experience, and just mathematically speaking, the best time to buy a stock is when it is trending down, but the business fundamentals are still in place. So if you are just trading these stocks and hoping they go up in the short term, unless you're doing something illegal, you don't know what this stock is going to do in the short term. You don't know what the quarterly earnings are going to say. You don't know whether it's going to go up or down. Honestly, if you really believe in the business, ideally when you first start buying it, it should start trending down so you can average your position down. You don't know when that bottom is going to be, so there's no reason to even try to time it. The only question you should be asking yourself is, do I like the price of this stock? If the answer is yes, you buy it. Do I like the price of this stock? If the answer is yes, you buy it. As it's trending down, the answer should always be yes if you bought it at a higher price, Unless the business as it's trending down, the answer to that question should always be yes, because you bought it at a higher price. Why wouldn't you be willing to buy it at a lower price? Hopefully you guys enjoyed this video and get some value out of it. If you do, make sure you give it a like. I don't think that actually helps the YouTube algorithm, but I just do it to make people cringe at this point. So I'll see you guys in the next one.